Welcome to Taking Stock video for the week ending the 11th of August, 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Equities Analyst, Daniel Ortisi, to stream to you all things share markets. How are you, Dan?
Yeah, good to be here, Kien, and obviously reporting season already starting to heat up, so lots to talk about today.
Yeah, there's been some interesting results, but before we get started, just a quick yet important reminder. The information we provide during this episode is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any charts or tables we present shouldn't be relied upon as a guide for future performance. Well, Dan, we are now around 2 weeks into this reporting season. What are your observations so far?
Well, Kien, certainly inflation continues to be a key theme this season, and is starting to impact profit margins, such as those revealed by Star Stocks, Credit Corp and ResMed. Meanwhile, resources companies like Rio Tinto have also experienced cost challenges across labour and energy in particular. Capital expenditures as well expected to rise, so therefore it was no surprise to see it pare back its dividend expectations significantly. Resource companies are still facing headwinds as well, with commodity prices expected to weaken further, Kien. And only this week, we saw China release data showing that the country slipped into deflation during July, which is when consumer prices are now starting to fall, and that was by about 0.3%. Although this could be a positive for inflation globally, as China is a key export market, it still signifies the weak local demand within the country, which of course is impacting commodity prices.
Yeah, very interesting. And one of the reasons why we removed Rio Tinto from our Star Stock universe. But those cyclical sectors, Dan, including retail and housing construction, they continue to face challenges. For instance, even though building materials business James Hardie's results beat market expectations, they did allude to a 10% decline in volumes and also warned that their higher margins were unlikely to be repeated. Meanwhile, retail department store Myer, they did warn that second half sales had grounded to a halt and is anticipating a 4.5% decline in online sales as well. And this trend could potentially impact other online-based retailers such as financially distressed business Kogan.com.
Yes, certainly, Kien. And moving across to property trusts, otherwise known as REITs, these companies are facing challenges of their own. Rising interest rates have caused these companies to begin to write down the asset values. And this is why investing in REITs with lower gearing and high occupancy rates, and specifically those who can raise rents in line with inflation, is so important. Star Income Stock and Industrial REIT BWP Trust is an excellent example of this.
Yeah, that's right. The impact of those rising interest rates. But speaking about REITs, Star Income Stock, Charter Hall Long WALE REIT, surprised the market by providing dividend guidance for financial year 24 below expectations at 26 cents per share. This compares to expectations of 28 cents per share, which was what it paid in the last financial year. And the revised guidance translates to a gross dividend yield of around 7%, which is still quite attractive though.
And of course, Ken, the reason for this was due to that rise in interest costs. Obviously, when you are looking at debt within these businesses, it is important to view it on what we call a look-through basis for a REIT. Now, this encompasses the true gearing of the business after including the borrowings with the associated joint ventures and partnerships as well. Charter Hall Long WALE REIT currently has a look-through gearing of around 40%, which is currently above its peer group. Another risk investors should be mindful of is the business's exposure to some of the more vulnerable sectors, such as office and retail. Meanwhile, the valuation of its pubs and hotel assets may have also been impacted by the changing gaming regulations.
Yeah, there's quite a few risks that we're currently assessing at the moment, Dan. But in other news this week, Star Income Stock and automotive retailer GUD Holdings, they announced the sale of their Davey Water business to Waterco. The code was WAT here, generating a net cash proceeds of around 56 million, which will be used to pay down debt. The sale of the business means GUD is now a pure play automotive after parts business, and having started the transformation back in 2014 following the sale of Sunbeam.
Yeah, that's right, Kian. And certainly the sale was a positive in our view, as Davey segment had been an underperformer in recent years. The overall earnings contribution from the business was only around 3%, so the sale should not detract from the group's overall performance as a whole. Importantly, the release of capital will help reduce its debt burden and strengthen the business's financial health even further.
Yeah, and we think this move is positive following its acquisition of Auto Pacific Group in 2021. GUD now is focusing on those growth areas towards four-wheel drives, accessories, SUVs, and electric vehicles. Currently, more than 70% of new vehicle sales in Australia are either SUVs or four-wheel drives. And this strategic direction should continue to support its earnings growth and dividend yield, currently at 5.4%, and the stock goes ex-dividend on the 25th of August. And now moving on to Suncorp, which reported its financial year 23 result. Profits were in line with expectations, but dividends missed by about 18%. And that's leading to a moderate, it was like a 2% share price decline on the day. What was the reason for the lower payout?
Yeah, that's right, Kian. And obviously the insurance division was certainly better than expected, and that was driven by improving margins over the second half of the financial year. But as you've mentioned, management lowered the payout ratio to around 60% of profits. Now, this was due to those uncertainties rising from the delay of the banking segment sale to ANZ, and also higher costs associated from its reinsurance disaster protection program.
Yeah, those insurance companies, they should continue to do well in an inflationary environment. And I noticed that the company was able to lift their home insurance premiums by about 12% without really impacting volume. Currently, the gross dividend yield for Suncorp is around 7.5%, with the stock expected to go ex-dividend on the 14th of August. The ACCC has also blocked the sale of its banking segment to ANZ, but the dividend yield could change if the appeal from ANZ is successful.
And moving on to the corporate calendar now, with reporting season, of course, in full swing, there are numerous companies reporting next week. Some notable ones include Challenger, Cochlear, CSL, Netwealth, and the ASX. For full details, please refer to our corporate calendar under the Stock Doctor platform.
In Under the Microscope this week, we take a closer look at Australia's largest retailer and business bank, the Commonwealth Bank of Australia. The company's share price reacted positively to the financial year 23 result, despite continuing pressures on its net interest margins. This is really the difference between the loan rates that they charge versus the deposit rates that they pay out.
Yeah, and from an earnings perspective, Kien, the performance was broadly in line with expectations, with earnings growth of around 6% year on year. The standout here was, of course, the 16% lift in full-year dividends to around $4.50 per share, exceeding market expectations as the bank opted for a higher payout ratio this financial year. This translates to a gross dividend yield of around 6% for CBA.
Yeah, certainly an attractive dividend yield on the back of the 6% uplift in its full-year cash profits. But I noticed that net interest margins came under pressure in the second half due to competition and higher funding costs, Dan. So what was the key driver of its earnings, really?
Yeah, that was very well flagged by the market, certainly the risk to net interest margins. And really the deterioration has proven to be more benign than what was initially feared. So higher interest rates have actually helped the business earn more profit from loans at a time where deposit rates remain relatively low. Business lending was also strong, and this represents around 28% of total revenue for the business. Finally, the positive effect was compounded by well-controlled operating costs by the company.
Yeah, quite interesting, but right. As with every financial result, though, there are concerns, and the bad debts, I noticed that they're starting to tick higher. Do you think that they have enough provisions to protect against potential loan losses?
Yeah, great observation, certainly, Ken. And while CBA cautioned that higher living costs contributed to growing debt in arrears, it's worth noting that loan repayments overdue by more than 90 days remained below long-term averages. So it is a sign that whilst there's an uptick in bad debts, it's not at alarming levels yet for the bank.
And I notice, having said that, Dan, the bank did become quite cautious and has recognised the potential for elevated credit risks from consumers and businesses. As such, the bank has raised its provision levels, which is significantly ahead of financial year 22 and even pre-COVID levels. So it appears that the bank is building up a bit of a buffer in case economic conditions worsen. Lastly, it was quite interesting for them to announce a 1 billion share buyback in 2024, especially after declaring 4 billion in dividends, Dan.
Yeah, well, the capital return surprised the market, Kien, in a positive way, but it does reflect the strength of CBA's balance sheet, which clearly carried an excess amount of capital. Rather than look to make acquisitions, announcing a buyback may signal that the company actually sees value within its own shares.
And despite the economic challenges, Dan, the resilience in those results should stem the negative earnings revisions for the bank. For those who want to pick up the dividend, the stock goes ex-dividend on the 16th of August. Now, following on from Commonwealth Bank's result, a useful question for income investors is, how sustainable are bank dividends for the coming year? If you look at a bank, remember they're highly leveraged to the economy, and the sustainability of dividends will depend on the strength of economic activity, which has been weakening though. As a result, dividends are expected to decline modestly for CBA and the other banks. But Dan, there are a few things to watch here.
Yes, certainly. And the first thing we would call out is a spike in the percentage of loan arrears or overdue payments. So CBA actually mentioned that about 1/3 of households have yet to feel the impact of rate changes on mortgage payments. As such, of course, we are cautious of increased borrower stress, but with unemployment at record level lows and the banks increasing their provisions to allow for losses, the risk does appear manageable at this stage.
Yes, and the second thing also, Dan, are their net interest margins. Remember the difference between what the bank charges in loans versus what they pay out in deposits. Margins have continued to be under pressure from competition for loans and deposits, and also those higher funding costs in wholesale markets. And this ongoing issue is driving expectations for slightly lower dividends in financial year 24.
And despite these risks, Kien, we do believe that the dividend yield for the banks have factored in somewhat of a softening in economic conditions. For example, ANZ and Westpac are currently on gross dividend yields of around 9%.
Yeah, quite attractive yields there, Dan. And National Australia Bank has a slightly lower yield at about 8%. But just remember that National Bank has the largest exposure to business banking, which is performing quite well and should help the business diversify its earnings from residential mortgages as well. That's all we have time for. Thanks for your insights, Dan. I know you're quite busy with reporting season.
Yep, it's really starting to heat up now, Ken, so it was good to be here today.
And if you have any questions about today's episode, please participate in our Lincoln Live webinar this Monday. Also, we've released a reporting season webinar providing insights into some of the themes and stock ideas from our analyst team. So you can find this in our resources center under the featured content section. Just to summarize, a key theme this reporting season are the cost pressures impacting profit margins. And rising interest rates are also impacting property trusts and retail spending. This is why focusing on those financially healthy businesses with strong market positions and defensive cash flows is very important. And the banks, well, their dividends remain sustainable for now. Have a happy, healthy, and prosperous week, everyone.